Chapter 9 is all about long-term assets, specifically property, plant, and equipment. And later in the chapter, we talk about intangible assets. But today is going to be focused on property, plant, and equipment. We are going to be focusing on the first two objectives in terms of when you actually see property, plant, and equipment on the balance sheet. How do they actually get that number? And then we're going to look at depreciation in a little bit more detail. And that's going to be our focus today. So first things first, plant assets are what we call property, plant, and equipment. They're long-term assets. They have a physical quality to them. So whether that's a building or a truck or a refrigerator, it's got a physical substance to it. Plant assets are used in the operation of the business. So if I had refrigeration systems, I would need to store food. If I had stoves or pizza ovens, that would also be used in the operation to cook my food to serve my customers. So these are used in the operation. Physical substance used in operation. We are not intending to sell any of that stuff to our customers. Customer can't come into my pizzeria and say, hey, you got a nice pizza oven there. I'd like to buy it from you. The answer is no, I need it. So it's not intended to sell to anybody. It's really there for us to provide a service. This is going to be, we're going to be using them for a number of years. So plant assets are going to be used for a number of years. So let's say I did have a pizza parlor and I had a pizza oven. I'm probably going to use that thing for a good 10 to 15 years. I mean, probably 10. I don't really know how long pizza ovens last, but I'm sure 10 is a reasonable number of years to get out of it. If I had a delivery truck, for example, that's another plant asset. Depending on how much I plan to use it, say, it might last me 5-6 years. So again, it's a number of years that it's going to be providing a service to the company. After which it's going to need to be replaced. Because it's going to have a number of years, these things don't last forever. What does last forever, as you'll see, will be land, which is also a plant asset. But you'll see some of the differences here. Back when I was in your shoes, we simply just called them fixed assets. Property, plant, and equipment are a major part of total assets for a lot of companies. I mean, take a look at Wendy's, which tops the list here. Well, think about all the property, plant, and equipment Wendy's has. Of course, they have the land, they have the parking lots and the drive-through. They have the building. They have the refrigeration equipment. They have all the ovens and fryers and machines that make the Frosties and blah, 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 countertops and tables and chairs and you name it, tons and tons of property, plant, and equipment. So it's no doubt that a lot of Wendy's total assets are property, plant, and equipment. It's also not unreasonable for Airways to have a large percentage of their assets in property, plant, and equipment because the biggest property, plant, and equipment they're going to have is a plane and many of them. So, of course, it makes perfect sense. Other companies may not necessarily need a lot of property, plant, and equipment to function. So you're looking at a balance sheet, you see buildings, you see equipment, and then you see a number next to it. How do they get that number? Well, they have to use what's called the historical cost principle, which means they literally have to put the asset on the books at what it costs them. Okay, so what you're looking at when you see building and on the balance sheet and then the number next to it, that's the cost. That's their actual cost. That's not the value of the building today. It's what it cost them to buy the building when they bought it, whatever that was. Okay. Another thing that's really important to understand about when you're looking at plant assets and this issue of cost is simply not just a cash price. Okay. we'll record every expenditure that we need to do to make the asset ready to use. So there's going to be a standard, you're going to hear about this, the ready for use standard, that's going to be used in calculating the cost of an asset. And you're going to see that applied very shortly. I'm going to touch base on these two issues, revenue expenditure, capital expenditure, in a future slide. I'll revert back. So again, cost is very, very important to understand in terms of plant assets. We are going to run up against another generally accepted accounting principle, which requires us to mark things at fair value. You'll hear about that in upper level classes that dive deeper into the issue, but here it's just noted. All right, so let's take a look at these plant asset accounts. Land is an asset account. And it's just that, it is the property, it's land itself. Okay, so if property, plant, and equipment, it's the property, land itself. So it's always going to be listed first under property, plant, and equipment on the balance sheet. So it's not just the cash price. Remember, you have to remember that ready for use standard is going to guide us in determining the cost of the land. So this is how it's applied. It's not just the cash price of the land, but before we can actually take the land, we're going to have to do something called pay closing costs. Closing costs are involved in any type of property, like real estate, real property, where the previous owner transfers ownership to you as the new owner. That's a legal process, has to be recorded, etc. And those are closing costs that require that to happen. Title is proof of ownership, and usually need attorneys to work out that. Another thing is, chances are if you're buying a piece of land or any other property for that matter, likely that person's going to be represented by a broker. And so you got to pay a broker's commission as part of the cost of that. So these are all required in order for you to take possession of the land. Another thing that's important to note is sometimes when you're buying a piece of land, there may be liens, legal rights to collect a debt that's part of that land. Back taxes, for example, is an example of that. Sometimes you have to pay those if it's part of the deal. So again, you have to get all of those paid off before you can say it's your land. Also, sometimes when you buy a piece of land and it's not on here, sometimes there might be some old stuff on the land, maybe a foundation of an old building that's fallen apart or whatnot. You have to take all of that off too in order to use it. So all of that would also be part of the cost of the land. So again, the standard is you got to make it ready for use. Okay, so that's important. So here's an illustration of that, and you're going to be asked to calculate the cost of these assets in your first homework assignments. We have a manufacturing company that buys real estate, just land here, $100,000 cash. The property has an old warehouse that needs to be raised. So to raise something is to basically tear it down, clean it out. The net cost of that was $6,000. It actually cost them $7,500 to do it, but they found $1,500 of stuff to sell to offset the cost. Net cost was $6,000. Attorney's fees of $1,000, real estate commission. Determine how land is going to be reported. The cost of land is going to be reported. Well, everything that you see here was required to be paid, and so to make use of the land. And so the cost of the land that you'll see on the balance sheet is $115,000. Okay, not just $100,000 you paid, but all of this is necessary to get the land ready to use. And so this is the value of the land on the balance sheet. Land is land. You put something on it, and a building is a building. What's a parking lot? What's a driveway? What's a sidewalk? Land improvements. This is a special asset account. land improvements. Um, and again, it's interesting because a lot of businesses will put driveways and parking lots, fences, and other things on their land. Well, this is the account you would need to debit for those assets. Those are assets. But as you know, for those of you that understand, because you've been driving around, you've probably been into parking lots that, like the Wendy's and Wappingers that I just came from, that it's all full of holes. I mean, it's just no good. Just needs replacing. Um, these things don't last forever. These things don't last forever. So whether it's a driveway, a parking lot, a fence, other types of things, they just don't last forever. Land lasts forever, but things we put on the land don't. So this means that if we did have a business and we put a parking lot on it, it would have what we call a useful life. Okay. Now, what we mean by useful lives, we're not making, it's not a degrading term here. It's just how long does the business plan to use it before it needs to be replaced? That's a useful life of an asset to a business. Okay. And all assets other than land will have a useful life. Um, so driveways are, I mean, parking lots are probably good for, somewhere between 10 and 20 years before they need to be replaced. I have a friend of mine who owns a building and parking lots in New Canaan, Connecticut, and he just had to replace his parking lot a couple of years ago because it just needs to be. It's an important asset, believe it or not. you know. So one of the questions is, what is the useful life? Well, if it has a useful life, it needs to be replaced. You're paying for things like a parking lot that you're going to use for your business. That you're going to replace that. So in essence, because you are going to spend money on this, the cost of this can be allocated over time as depreciation. You can't write it off right away because, again, remember in accounting, to expense something, you have to use it first, right? That's why when you buy supplies, supplies is an asset, but after you use it, it's supplies expense. When you buy insurance, prepaid insurance is an asset, but after you use it, it becomes insurance expense. All of these plant assets, except land, when you buy them, they're your assets. But when you use them, they become part of depreciation expense. The problem is supplies you use very quickly. A parking lot you can use for 10 years. You can't expense them the same way. Depreciation works differently. It's like a very slow drip, you know. You're going to take a little bit of depreciation over a long period of time. So that's the big difference. That's the big difference here. Okay. Another very important account that's an asset account, again, is buildings. And again, with buildings, you got two choices. You're either buying a building that already exists, or you're putting a building up that doesn't exist already. So both are important to look at. For buying an existing building, yes, you're buying it for a certain price. It is real property, so there's going to be closing costs that are involved, and chances are there's brokerage commissions that are involved. So that's pretty normal when it comes to any type of real property. However, before you can actually use the building, it has to pass code, right? There's building codes and other safety related types of things that need to be checked before you're given permission to open a building. And so, guess what? If there's any remodeling that has to get done, if you've got to replace whether it's the plumbing, electrical, the floors, the roof, what have you, if that has to get done before you can use it, guess what? It's part of the cost of the building. Okay. Because the standard is ready for use. So if you have to do all of that before you can actually use it, it becomes part of the cost of the asset. The other option is, of course, there's no building there, and you bought the land, and now you want to put up a building. All right, well then you have a lot of construction costs to go as part of that. You're going to need to hire an architectural firm to design all that type of thing. You can't just decide to put up a building. You need permission. There's lots of different permits that have to be granted. Those cost money. Depending on where your building is, you're going to need to dig a little bit. If it's in the city, you're going to be digging a lot. But you'll have excavation costs that need to be had. All of that in addition to constructing the actual building. So again, all of that has to be done, and that's going to be part of your cost of the building. Equipment is another account. It can be used as sort of a catch-all type of an account. So literally when you buy a vehicle, you can call that equipment. A lot of businesses don't like to do that. A lot of businesses will have their own accounts for vehicles. But in smaller businesses, it's very common to say if I had a delivery truck as a pizza place, it'd be part of the equipment account, as would my pizza oven and my refrigeration system and my tables and chairs and all this other stuff. So equipment could be that catch-all. And again, everything has to be ready for use. So what's the cost of a piece of equipment? Well, you're not just paying cash for it. Equipment is usually a manufactured product. When sales taxes were introduced way back in the day, sales taxes were on manufactured products. Okay, and so since equipment is a manufactured product, sales taxes often apply to that. You're not buying this from your next door neighbor. You're going to have it shipped to you. So oftentimes you'll have freight charges and insurance that have to be paid. All of that's there. Then when it gets to you, it might need assembly. You might need to do special installments. And installing might also be, you might need to build a special platform for the equipment to sit on, that platform has become part of the cost of the equipment. You might need to test the equipment. You might need to train certain people if the equipment is new, and they're going to need to function that. All of that becomes part of the cost of the equipment. Again, as long as whatever gets the equipment ready for use, that's the standard that we use to assess the cost. So here's an illustration with a company. Leonard Company buys a delivery truck for $22,000, pretty small truck, I'm assuming. Sales taxes are $1,320. They have to pay, and letter that truck for $500. Motor vehicle license was $80, and insurance was $1,600. What's the cost of the actual equipment, the truck itself? Well, the cash price plus the sales taxes. Plus, a lot of businesses, UPS, they like to paint their trucks brown with the UPS golden signal on it and so forth before they send it out into use. Amazon likes to paint all their trucks, etc. Painting and lettering is often part of getting it ready for use. But guess what? That's it. The license gets the driver ready to use the truck. Doesn't get the truck ready for use. Gets the driver ready for using. And every time you buy insurance, you understand it's prepaid insurance. So that truck would actually be debited for $23,820. That's the real cost of the truck. Okay. So on their books, you would see they spent $25,500 in cash on this, but only $23,820 is literally going to be debited to the equipment account. To buy that license, the licenses are simply expensed. It's a general expense for the business. And anytime you buy insurance, we have our own asset for that, prepaid insurance. All right, let me go back to the issue that was back on the earlier slide. It has to do with this. Anytime you have an asset, say a delivery truck, for example, it's only going to be good for so long. And in order for you to have a truck for 5 years, for example, a delivery truck, you're going to have to keep it maintained. So regular maintenance, changing the oil and filters, the tires, things like this, that's just part of everyday ordinary repairs. And so we simply expense ordinary repairs as part of maintenance and repairs expense, just a general expense for the year that it happened. Okay. However, If we do something that actually changes the useful life of the asset, then we consider it an addition and improvement. Why? Well, because we basically increase the useful life of the asset. Here's an example. Same delivery truck. We've used it for 2 years, and the third year we're starting to use it. It breaks down. We overhaul the engine. Now, when you overhaul an engine, you're basically giving the truck a brand new engine. And if you got a brand new engine, it can last another 5 years. So that is an addition and improvement, because basically you've extended the life of the asset, because what you've done is you've given it a new engine, right? So that means we're going to be actually increasing. We're going to debit the actual equipment account, or whatever vehicle account, whatever it is in, and that's going to be a difference. Ordinary repairs, to go back to the earlier slide, is part of those revenue expenditures, because they're simply expensed. Capital expenditures are additions and improvements, in essence. Companies have a lot of leases. Leases are very, very commonly used in companies. It's a contractual agreement, right? You get the asset from another party, but they have to pay for that, right? So what happens here? There's certainly some advantages to leasing for the company, but in terms of what we care about on our balance sheet and so forth, the assets, the leasing of equipment is an asset, but the cost, what we owe on the lease, is a liability. So in essence, they cancel each other out. They are not reported on the balance sheet. Leased equipment is not reported on the balance sheet. They are talked about in the notes to financial statements. So that's important to use. And again, many firms use leases. Okay. As a matter of fact, in the case here, you got about 40% of the commercial airlines that are flying or used to fly, they're all leased vehicles. Okay, so that's learning objective 1, talking about the actual fixed assets and how we come up with the cost of those. Learning objective 2 explains depreciation in a little bit more detail. Okay, so remember, we buy an asset for a useful life. The reason we have a truck is we plan to use it for so many years, and then it needs to be replaced. So because we have to replace it eventually, right, we get to allocate some of the cost of that asset as depreciation expense. Okay. The process that we use simply we call depreciation a cost allocation process. That's how it's officially known. And it's really applied to everything that has a useful life, right? In other words, everything that needs to be replaced at some point in time. So I talked about that parking lots don't last forever. They're going to need to be replaced. Buildings have a very long life. They have a life of 30, 40 years sometimes. But eventually, you need a new one. Equipment depends on what it is. Some equipment, doesn't last very long. Some equipment lasts a long time. So like I said, you buy a computer system for your store, on my pizza parlor. That might last me a few years. My pizza oven, my refrigeration system, I'm hoping 10 or more years, right? So a lot of it is based on that, but it's going to have a useful life. This doesn't apply to land, because land is always useful. Okay. And that's how we look at it from this perspective. Okay. Remember, the reason we have our building, whether we have our equipment, etc., is because they're helping us sell the products that we have. So for Wendy's to sell its stuff, for example, right, you need a place to park and go in the building, place to sit down and eat, etc. It needs drive through equipment, etc. All those things are property, plant, and equipment expenditures eventually, but they but they're necessary to produce revenue. Okay, and so because they are linked to revenue, is why depreciation is part of our way of, we use it as an expense, right? An expensing mechanism, because it's linked to revenue. Remember, revenues and expenses are linked. So this you already found out. These are some factors that are important. You already know about the cost and how to calculate the cost from learning objective 1. That's the first thing you got to do. What's the cost of the asset? Second thing you got to do is figure out what its useful life to the business is. In accounting, this is relatively standard. There's a lot of accounting rules that have already put into place how long different pieces of thing, equipment and buildings, etc., how long they last. Okay, so there's already standards in place to figure out a useful life. One thing that's new that you haven't seen before is this issue of salvage value. Some books call it residual value. This book calls it salvage value. What does it mean? Well, once we're done, once the business is done using it through its useful life, will it actually have any value at the end of it? So in some cases, no. In some cases, yes. So which cases? Well, computer equipment after 4 years old, whatever, no one's it doesn't have a value. No one wants to buy a 4-year-old or 5-year-old computer system. So 0. However, things like trucks and various machines, large machines, particularly in manufacturing, even though they're older, they sometimes will have, and they've been used a lot, they sometimes have a residual value. It'll be small. It'll be small. So salvage values tend to be small, but it's a recognition that we haven't used it, the entire value of the asset through its useful life. So this is something that you're gonna be aware of as well. Useful life. In calculating depreciation here, we're only going to be learning how to do it in years. Okay. There's different ways to calculate a useful life, but we're going to stick with years. Why is that? Well, because of all the depreciation methods that are available to companies, there is clearly a straight winner here. 83% of companies use the straight line method. So it's clearly, and at this poll, no voter fraud. So this is certainly straight line is the most popular for a couple of reasons. Probably the most common reason is it's also required by the IRS for tax purposes. So you might as well use it anyway. There are other ways in which to calculate depreciation. One is called, formally it's called declining balance. Some books have it as double declining balance, but it's an accelerated method. It's accelerated depreciation in essence. And the last way some companies do it is called the units of activity. So let's go back to our truck. On the straight line, we use years. Under units, we'll use miles. A mile is a unit of activity for a truck. Okay. And so if a company wanted to just depreciate it by mile, they could do that. It's just a pain in the butt to do it that way. It's just easier to do straight line. And here's the example. Here's Bill's Pizza. They bought a small delivery truck. How small? 13,000. That's pretty damn small. I don't know if it's got like you wind it up in the back. That's how small it is. Or there's a cord to pull to get it to move. I'm not really sure. But that's a small truck. I don't think there are any $13,000 trucks out there that aren't beat up. That's the cost. That's important. Right? That's learning objective 1, cost. Like I said, a couple of things. We have to figure out its Its useful life, again, we're going to be using years because straight line method uses years. And at the end of that life, is it going to have a salvage value? In this case, we think so. We think it's going to have $1,000 salvage value. So this is the information that we need to know to do straight line depreciation, which is the only thing we're going to focus on. Okay. Like I said, the units would be miles. We're not doing that. And we're not doing accelerated depreciation. So you don't have to worry about that. So how does it work? For straight line method, we simply take the cost of the asset, subtract out the salvage value of the asset. The difference is how much we're going to use, which is the depreciable cost. Okay. So if this company bought a truck for $13,000, once it's done using it for 5 years, it's going to have a salvage value of $1,000. So how much of the truck's value are they going to use? That's the difference, $12,000. That's the depreciable cost. You take the depreciable cost and divide it by the useful life in years. Divided by 5 years. So every year, the expense is basically the same amount. Now, this only happens if you own an asset for the full year. So for example, if you have a regular calendar year, you've had to purchase that asset in January, and you've used it all the way through December, 12 months. Okay, that's what the depreciation expense is for all 12 months. So your book explains it in a little bit of a different way. But again, with anything, there's lots of ways to explain it. First of all, here's the 5-year period of time that Bill is going to depreciate his truck. And again, the depreciable cost is the amount, right? The value of the truck he's going to be using over that period of time, which is $12,000. He's going to be dividing that into 5 years. And so literally every year, 20% of that is going to be written off. So every year at the end of the year, because this is simply an adjusting entry, they're going to have a depreciation expense for $2,400. And they're going to have a credit to accumulate depreciation for equipment for $2,400. Okay. Now, you know what happens with expenses, right? These close every year. They're temporary accounts. Chapter 4, we close out our expenses at the end of the year. And so when we do this again in 2018, we're going to do the exact same journal entry, a debit to depreciation expense and a credit to accumulated depreciation. But as you see, every year we take the expense, it accumulates in accumulated depreciation account. Accumulated depreciation is an asset account, contra asset. It's got a credit balance, but it's an asset account. So every year we take an expense, you'll see it accumulate in accumulated depreciation. Okay. 5 years of expenses will accumulate into the $12,000 total depreciable cost. That's how much we're going to depreciate $12,000 over 5 years. And this is the slow drip. Okay, a little bit over 5 years. So that's important to know. Expenses are closing out every year, but you'll see how much you've expensed by looking at accumulated depreciation, because it just keeps accumulating. Right after these 2 years, it's $4,800. After these 3 years, it's $7,200. After these 4 years, it's $9,600, etc. Another thing you have to know is book value. We look at the cost of the asset and we subtract out the accumulated depreciation. That gives us something called book value. Book value is simply the difference between the cost and what's already been depreciated. Remember, the cost of this truck is $13,000. That's the cost of the truck. Okay. We're only going to depreciate $12,000 of that over 5 years, but the cost is $13,000. After the first year, we've only depreciated 1 year of it, so only $2,400 has accumulated for depreciation. We subtract $13,000 from 2,400, that's the book value, $10,600. After the second year of depreciating it, we now have $4,800, right? That's 2 years of depreciation totaled, accumulated. Book value would be 13,000 minus 4,800 after the second year. It's going to be worth $8,200 on the books. After the third year of writing it off, we have now written it off 3 years in a row. It's accumulated to $7,200 of accumulated depreciation, minus a $13,000 cost for the truck. It's a $1,500 truck now on the books. Okay, we'll do this all the way until your last year. Notice in your last year, the most you can write off is what you said you were going to, 12,000. So accumulated depreciation stops at the 12,000 that you said you were going to write. And look what also happens. The book value also stops at the salvage value you said it was going to have when you were done using it. Okay, so that's basically important to understand how that all works. Now, one of the questions that always comes up is, well, what if Bill uses a truck in 2022? Yeah, he can still use the truck in 2022, but he can't expense any more of it. It's already been expensed. Okay, he can't expense any more of that. That truck has been fully depreciated on the books now. Okay, so doesn't mean they can't stop using it. They can use it if they want to, but they can't expense it anymore as depreciation. And again, that's for the full year. What if they bought it later in the year? Well, again, it is true that you're going to be, expensing $2,400 a year. Okay, the current expenses is going to be 24. But if you only bought it, say in April, you only owned it for 9 months during that first year. So only during the first year, even though it's $2,400 for the annual expense, which is 12 months, for the first year, you've only owned it for 9 months of those 12. So you can only write off $1,800 the first year. Those other 3 months, simply tack it on at the end. So again, these 9 months plus these 3 months is 1 year, 2, 3, 4, 5. You still have the full 5-year depreciation. It's just that it's partial year in the first year. Throw the remainder in the last year. Okay, you'll still get your full $12,000 in this case for Bill's truck. Okay, will be written off. So that's something that's going to come up. Regardless what choices that management has for using depreciation methods, if Bill chose straight line or declining balance or units, which is using the miles of that truck, the same thing would apply, right? The total amount of depreciation cannot be more than $12,000. Doesn't really matter. Straight line here, you see everything is the same all year. Declining balance is basically double, what we call double straight line rate. But basically, as you see, most of the depreciation is taken in the early years. The remainder is taken in the later years. This is why it's called accelerated depreciation. Most of the depreciation is accelerated to the first couple of years. Units of activity is based on the number of miles. The more miles you drove, the bigger your expense. The less miles, the less. It doesn't matter how many miles you drive at the end here, you are stuck with, you got to stop at 12,000 because that's what you said you were going to do. So management has, they can choose, just like they can choose FIFO, LIFO, average cost for inventory. Here they can choose a depreciation method, but it doesn't mean that they get any more benefit or they can write off more with one versus the other. No. And like I was mentioning earlier, straight line is very popular because it's used for taxes. The IRS requires a straight line method. However, the IRS does have its own depreciation method called MACRS, Modified Accelerated Cost Recovery System. This is for tax purposes, not for reporting purposes. So MACRS is not part of GAAP, but straight line is. All businesses need to put it in their notes. So they will make a note on depreciation. Here we have Southwest Airlines. They use a straight line method, right? Here they have, and they usually have more detail in the notes, but here for flight equipment, their depreciation is between 23 and 25 years for flight equipment. So think planes, right? 5 to 30 years for all that ground equipment. Okay. So they will disclose all of that and tell you what's going on. One more very important aspect when it comes to assets is something called impairment. An impairment is simply a permanent decline in the value of an asset that has to be reported on the books. So I'll give you two quick examples. One deals with Disney or a company like Disney. I think about maybe a long time ago, at least probably 10 years ago or longer, Disney made a movie called Waterworld. It was a flop. It was a multi-million-dollar flop. Okay. So movies are part of copyrights, they're intangible assets, they're valued on the books similarly to fixed assets. However, when literally Disney had to pull the movie out of the theaters after the second week because no one was seeing it, it knew that at that point in time, the movie didn't really have much of a value. So that's an impairment. To bring it into the fixed assets that we're talking about, let's talk about one of Robinhood's favorite stocks, which is Aurora Cannabis, Canadian medical marijuana, recreational marijuana company. A couple of years ago, when it looked like marijuana was smoking hot, you can say, those stocks were going well. Aurora went on a buying spree. They bought a lot of buildings because they're in Canada, right? So you can't grow weed in the winter unless it's in a building. Right? You need certain favorable conditions to grow any type of plant. So they went on a buying spree. They bought lots of capacity. They bought a lot of buildings that had internal growing mechanisms and so forth, expecting demand to really bud, blossom. It never happened. Still hasn't. So they spent a lot of money on these buildings and equipment that they didn't use. It actually became quite useless. So after a year or two, they had to declare it was an impairment. It was a permanent decline in the value of an asset. And so they put that down. So that basically is something that happens in real life all the time. They don't want it to happen. They don't purchase those assets for that to not to be used accordingly, but it does happen. It does happen, and so they have to claim it as an impairment. I hope that didn't impair your understanding of anything, or in the case of Aurora, it impaired your judgment. Get it?